So today we begin with sales variances, where we had stopped in the last lesson. Sales variances. Sales variances. And we are going to use this question of question number 2 in our handout, that is on page number 9. Question number 2, that's the one that we are going to use, that says that the budgeted sales for the Juakari company for a period were, we are given those items, the actual sales, the budget, actual industry sales volume were that. So you're required to get the sales variances. So the first thing is called total. Total is given as a budget contribution. Budget contribution, you minus actual contribution. You minus actual contribution. Budget contribution, you minus actual contribution. So what we are going to do is we shall go where there is the budget. Or first of all, in the question paper, you can see where there is the unit variable cost and selling price. So we can first of all compute the contribution margin. So the contribution margin per unit of J, it is 40 minus 15. Contribution margin is 40 minus 15. That gives us 25. And then the contribution margin per unit of product K, it is 50 minus 25. So that gives us 25. Then budget contribution will be equal to this one is 25 times the number of units, which are 24,000. Plus this other one also has 25 times the number of units, which are 8,000. So send me that figure. Send me that figure, Sharon.
800,000.
800,000, good. So that is the budget contribution. Let's now get the actual contribution. The actual contribution. I think we'll need to get the, maybe first of all, before that, let's get the contribution margin of J under the actual, which is 45 minus 20. That is 25 again. And then the contribution margin of K, this will be 60 minus 22, and that gives us 38. So the actual contribution is 25 times the number of units, which are 20,000, plus 38 times 12,000. What are you getting?
956,000.
956,000. Good. So then it means that the total variance will be equal to the budget contribution of 800,000 minus 956,000, and this will be 156,000, and this is favorable. It is favorable because the actual is more. You can see the actual is more than the budget. That's why it's favorable. The next variance is called price. It's called price. Now the one for the price is given as standard contribution margin minus actual contribution margin. Standard contribution margin minus actual contribution margin, you multiply by actual units sold. You multiply by actual units sold. And this one, maybe I can specify, this is for operations purposes. When we talk about operations purposes, we are referring to when you want to measure whether your operations are effective, whether you are doing a good job or not. So if we start with the product J, the standard contribution margin we have computed earlier here is 25. The actual is 25, and the actual units sold, we are 20,000. So this gives us a zero variance. This other one, K, is 25, and the actual is 38. The actual is 38. So with that, we have the actual units of 12,000. So add those or work out that 25 less 38, you multiply by 12. What are you getting?
Negative 156,000.
So this is 156,000. Now this one is favorable. It's favorable because you can see we got a higher contribution margin. Now alternatively, this price variance is also given as budget selling price. Budget selling price, you minus actual selling price. Budget selling price, you minus actual selling price, you multiply by actual units sold. Now this one is used in reconciliation purposes. It is used in reconciliation purposes. If you are told to reconcile profits, you are told to do a reconciliation statement, that is when you use that that formula. That's when you use that formula. Now that for now, what I'm doing or what we are doing is operations. I will not compute this, but in the next few minutes, we shall come back to, or we shall be looking at how to reconcile. So that is when we shall use that formula. So the next one is called volume. And volume is given as budget sales units. Budget sales units, you minus actual sales units. Actual sales units. Now this one you multiply by standard contribution margin. Budget sales units minus actual sales units, you multiply by standard contribution margin. So when we get to product J, the budget was to sell 24,000, but we ended up selling some 20,000. And the standard contribution is 25. So if you take 4 times 25, what are you getting? Mm-hmm. 100,000. It's 100,000. Then when you come to K and you take the budget sales was for 8,000. You minus the actual sales, which were 12,000. And standard contribution was 25. This is also 100. You need to specify which one is which. Now this one, because we sold fewer units, this is adverse. But this is favorable because we sold more units. So when you combine them, the answer is 0. The answer is 0. And you can see what I've been saying, that if you add this volume to this price, they should bring you back to the total here. You see, this is 0 plus 156 equals 156. Equals 156. Jackson, welcome, and mute yourself. Not unless you want to speak. Good, thank you. So we now proceed to compute the one for we are still proceeding with the sales variances. So the next one is mix. Now, when they ask of the mix, we say it is the revised mix. Revised mix minus actual mix. Revised mix minus actual mix. You multiply by standard contribution margin. Standard contribution margin. Standard contribution margin. So for product J, when you are told to get the revised mix, you say J had 24 in a total of that 2. That is the budget. 24, the total is that 2. That is 24 plus 8. And here, when you multiply by the actual coincidentally also happens to be a total of that 2. It happens to be a total of that 2. So you minus the actual, which is 20,000. And the standard contribution margin, we had gotten 25. So this takes us back to 100,000. And this is adverse. It is adverse because we got smaller than what we thought we could get. Then for K, it is 8 out of that 2. You multiply by that 2, the total. You now minus the actual. The actual is 12,000. And standard contribution margin of 25. So that gives us 100,000 again. But now this one is favorable. And consequently, when you combine them, the answer is 0. When you combine them, the answer is 0. Huyo mwingine huwa anaitwa quantity. Now, quantity is sorry, I think I've mixed the formulas. I think I've mixed. This is the one that is quantity. Sorry, this is quantity. Change there, and this is the mix. So now I give you the one for mix. Sorry for that. The one for mix. That 2 is coming from this 24 plus 8. That's where I'm getting that 2. Which I'm saying 24 out of that 2. Then this other one that I'm using, that 2,000, it is the 20 plus 12. That's where I'm getting that 2. Is that okay, Sharon?
Yes.
Good. So this formula is given as revised mix. Revised mix. You now minus the budget sales or the budget mix. Let me call it the budget mix. You multiply by standard contribution margin. Standard contribution margin. Standard contribution margin. So in this, J, the revised mix are still like we have here, times that 2,000. The budget was for 24,000. And the standard is 25. So this becomes 0. That becomes 0. K is 8 out of that 2. Multiplied by that 2,000. You minus the budget of 8 at 25. That becomes 0. And the total is 0. And now you can see these 3 here. When you add them, this and this, we go to the other one, the one that we had for the volume. The one that we had for the volume. The one that we had for the volume. Okay. The next one is market share or market size. Now, market size is given as budget industry sales volume. Budget industry sales volume. You minus actual industry. Actual industry sales volume. Actual industry sales volume. And this one you multiply by budget market share. Budget market share. Budget market share. You multiply by budget average. Budget average contribution. Budget average contribution. That is how you get it. So in implementing this, you can see there we are told the sales volume, the actual industry sales volume was 200 and the budget was 320. So this is 320,000. You minus the 200,000. That is the volume. When you come to the share, you argue like this. According to our budget, if you equal budget, we were planning to sell that 2,000 units in a market that had 320,000. So that tells you we were contemplating getting 10% of this market. 10%. So you now multiply this by the budget average contribution. The budget average contribution is kuna ile contribution tulikuwa tumepata kwa budget. I think it was 800,000. The budget contribution, and this 800,000 was to be realized after selling that 2,000 units. Was to be realized after selling that. So work out that and tell me the answer. Yes, Sharin, what have you gotten?
300,000.
300,000. Yes. 300,000, positive or negative? It's positive, eh? So if it's positive, this is adverse. It is adverse because we got a smaller market share. We got a smaller market, oh, sorry, we got a smaller industry. The industry volume was supposed to be 320, but we only got a turnout of 200. The next one. The next one you compute as is called market share. Market share. Now this one is given as budget market share. Budget market share. Budget market share. You minus actual market share. Actual market share. Now this one you multiply by actual industry sales volume. Actual industry sales volume. You multiply by budget average contribution. Budget average contribution. Budget average contribution. Budget average contribution. So as we have said, the budget share was that 2,000 in a total of 320,000 as the budget share. The actual share is we sold 200,000 in a total of no, we did not sell 200. We sold that too. The actual sales were that 2,000 in a total of 200,000. In a total of 200,000. The industry sales volume actual is 200,000. And the budget average contribution is 800,000. You divide it by that 2,000. You divide it by that 2,000. Bata jibu niambie.
Negative 300,000.
300,000. Now that negative 300,000 is a favorable variance because the market share is bigger. The actual market share is bigger than the budget. That's why it's negative. Yeah. So that is now what we call or how you compute those sales variances. Now on your own, you can attempt question number 3. On your own, you can attempt question number 3. Now from there, let's proceed to variance investigations. And variance investigation is simply an exercise where we want to know why the variances came about. And we have very, very many reasons why variances can be noted, but all those are broadly classified into 4 reasons. The first reason is called, or the first category is called measurement errors. This is where whoever was sent to go and take the measurement makes a mistake. And based on that, then we report a variance. Just like what I had done here when I wrote mix instead of quantity. That's a measurement error and it creates a variance. The other one is out of date standards. Maybe you see now when we are talking of standard contribution margin, you report standard ya kitabu, but things have changed. So if things have changed, then that is going to cause variance. The third reason is what we call out of control operations. This is where something has already gone out of control, but you are doing nothing to bring it back. You are doing nothing to bring it back. The other one is random or uncontrollable factors. These are reasons that are beyond your control. Like now on Monday, we shall not have a class, most likely because there is a holiday. Now, holiday is something that is beyond us. We cannot go and tell the government that don't declare Monday a holiday. We have a lot to do. The exams are just around the corner. No. So that is going to make us to miss the lesson. Is something that is called random or uncontrollable factors. The factors that you need to consider when you want to think about investigation, one is about the size of the variance. Quite often people investigate the big variances and they ignore the small, but it is important that you also investigate even the small ones. The issue of the type, whether it is adverse or favorable, In most cases, people want to investigate the adverse. They don't want to investigate the favorable. If I do something good to you, you may not be really much concerned why I am good to you. But if I do something bad to you, you may be immediately concerned why I am mistreating you or why I'm bad to you. But the recommendation is you should investigate all of them. Whether I am good or I am bad to you, don't just take it for granted, seek to know why that is happening. Because things don't just happen. Things don't just happen, there is a reason. The other one is about the cost. You must be able to know how much will it cost me if I embark on this investigation. Am I going to incur too much? Or is just something little and I discover the reason? And closely related to that, you should also look at the benefits. How will I benefit after I do this investigation? Will it be something significant or something that is insignificant? The next reason is the past patterns. Now, if something has just occurred for the first time, we may not be quick to investigate. Actually, we may not even understand what is happening. Someone can come and do or tell you something, and it does not even click to your mind what they are saying. Maybe they mean something good or they mean something bad. But because it's the first time it is happening, you don't really get it. But when it is done over and over, that is now when you start saying, oh, no wonder now you start understanding, you start noting the pattern. And when the pattern continues, now you may want to know why, you may want to investigate. That's why you hear people say, umenizoea, you have come too much. Now that too much shows you that the pattern has been there, the trend has been there, and it's time that we investigated. The other one is the budget. Now, when we talk about the budget, you can see like now, budget what? The question is, how reliable was this budget? Was it done well? Was it realistic? Is it something that is practical? Otherwise, you could be having budgets that are out of this world or out of reality. And they will therefore create variances all through because they were done poorly, they were not reliable, they are not realistic, and so on. So you need to check, how is my budget? Who made it? And so on. The other thing, and Indika mentioned that, is reliability of the figures. Even the actuals, who gathered this information? What cares were taken to ensure that the figures we're using are accurate, or we just want to go with whatever is presented to us? Those are some of the factors that you need to consider when you are considering to investigate variances. Now, there are three methods that we use to investigate variances. The first one is called simple rule of thumb. Now, simple rule of thumb, it is where you don't have anything that is guiding you. You simply stand up and say, in my company, the variances will be this. If you spend less than this or more than this, you shall be investigated. It's as simple as that. And this method, it does not consider the cost, it does not consider the benefits, it does not consider the significance of the variances. So it is not a very good one. But nonetheless, it is still very popular because it is not involving. You only need to look up or down or wherever, and you say, hapa kwangu, mambo itakuwa namna hii. Mtu akipitisha hapa, ama asipofikisha hapa, we investigate. It's as simple as that. The second method is called statistical model. Now, this one is based on a probability method, normal probability method, and it also relies on two assumptions. The first assumption is that the system is out of control, and it is because of factors that are beyond control. Like now, what I've said on Monday, if anyone would come here, they will find that there is no normal operations. It is not that Destiny has stopped teaching, but we are still teaching. It's only that on Monday, there will be a factor that is beyond us. The second assumption is that the system is actually out of control, but a corrective action can be taken. It's like you come and find I'm not in class. That does not mean I've stopped teaching. Maybe I have gone to attend to a function somewhere, but tomorrow I will come back to class. So for today, now that I'm not in class, it is actually out of control, but a corrective action can be taken. Yeah. Just like now, the rest of you who are not in class, we cannot say they have stopped attending classes. It's only that today they are held up somewhere for various reasons. But come next lesson, you'll find them there. So that is the meaning of those two assumptions. Now, this one, we draw something we call statistical quality control charts. We draw some charts that are known as statistical quality control charts, from which we make inferences. And I think before we do that, I should have shown you how to reconcile. So before we draw the chart, let me digress kidogo. I go back and I show you how to draw profits reconciliation before we draw the statistical. Or now that we have started talking about the investigation, yeah, let me do it as the last one. Let me do it as the last one here, reconciliation. Yeah, so that I don't disrupt the order. Okay, so I want us to go to this question that was tested a few years ago. This question that is on page 174 of our past papers, the question of June 2001, question 4. The question of June 2001, question number 4. So June 2001, question number 4. And the question says, Skyline Limited operates daily round trips, flights on the Nairobi-Mogadishu route using a fleet of 3 light aircrafts. These 3 aircrafts are Skyline 1, Skyline 2, and Skyline 3. The standard quantity of fuel used on each round trip over this 12-month period has a mean of 100 kl and a standard deviation of 10. James Duo, the operations manager of Skyline Limited, uses a statistical quality control approach in deciding whether to investigate the variances from the standard fuel usage per round trip flight. He investigates all those flights with fuel usage greater than 2 standard deviations from the mean. In addition, James Duo monitors threads in the SQC charts. It should be SQC charts to determine if additional investigations decisions should be made. James Duo received the following reports for round trip fuel usage for the month of May 2001 from the pilots of the 3 planes operating on the Nairobi-Mogadishu route. So we are given that data, and now we are told using a plus or minus 2 standard deviation rule, indicate the variance investigation decisions which should be made. Okay, so that one we are going to have what we call variance investigation rule, and this rule is plus or minus 2 standard deviations. Now this rule creates what we call the upper limit and the lower limit. So for the lower limit, it is x bar plus or not plus, that is minus 2 standard deviation. So the mean is 100,000 and the standard deviation is 10,000. So that gives you 80,000. The upper limit is X bar plus 2 standard deviation. So this would be 100,000 plus 2 times 10,000. That is 120,000. So the rule is then done like this. You can either draw, give it as now this is X1, which is 80,000. This is X bar, which is 100,000. This is X2, which is 120,000. And then here, if you are here, you say investigation. This one, we will do an investigation. If you find yourself here, no investigation. No investigation. If you are here, we have investigation that way. And here, standard deviation is 10,000. Standard deviation is 10,000. Once you finish drawing, you let me know. Professionals are interested in Sorry, what is that?
Yes.
Good. So if we are finished, then we now need to draw the statistical quality control chart, which is guided by this rule. The statistical quality control chart. And what you do, you check those values that are given there. It will tell me which one you can see as the lowest. The lowest of those values, now Nagani.
The lowest of the three out per skyline 1, 2, or 3.
Then?
The lowest of them all.
For them all. For them all.
I can see 92. 92.
92. Good. And the highest?
126.
126. Now the lowest is taken to be the lower limit that we have gotten to, which is 80. So we are going to take a graph that is running from 80 to 126. So this is what we will do. So we want to draw a graph. One, 2, 3, 4, 5, 6. So I say 8 and 9 to 100, 110, 120. Yeah. So if I take this to be 80, this is 90, this is 100, this is 110, this is 120, this is 130. Now this is y-axis there. Now here we break the scale by drawing something like that. Breaking the scale means this distance it is representing more units than these other two distances. What to represent 10, 10, but you can see the whole of this is representing 80. That's the meaning of that. Then now here I have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So this is x-axis. So the flights are 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So this one flight number. This is flight number. Then this is fuel usage. Fuel usage in kiloliters. Fuel usage in kiloliters. Then our, this is 80 and 40. So this is the lower limit. That is the lower limit. Then here we have the upper limit as per what we found out in the rule. This is the upper limit. And the title of this graph, we need to give it the title. What we are drawing is called statistical quality control charts, SQC, statistical quality control charts. So you start plotting. The first one is 104. At 1, I have 104 somewhere here. The next one is 94. So 94 is here. The next one is 97. 97 must be here. The next one is 101. The next one is 105. The next one is 107. The next one is 111. 111. The next one is 112. 112. The next one is 115. The last one is 119. It's 119. So those values, you join them using a very smooth line. And then you can tell us this is skyline 1. That's skyline 1. We do the same for the next 103. Equal to 103. So 103 is here. Maybe I can use to start Evo. The next is 104. So 104 is here. The next is 9. No, it's 94, not 104. 94. So 94 is there, followed by 96. So this is 95. So 96 is somewhere here. The next is 107. 105 ni hapa, so 107 ni hapo. The next is 92. So 90 must be this one. So 92 is that. The next one is 113. So 110 is here. So 1, 2, 3 here. The next one is 99. So 100 is 100. That's 60. So this is 100. So 99 is here. The next one is 106. 106. So 100 tumesema ni hapa, 105, so 106 ni hapa. The next is 101. 101 here. So that one. And the last one is 93. So this is 80. It's 91, 2, 3. So this one. So that is skyline number 2. Skyline number 2. We go to the next 97. So 7 is here. So I put a dot there. The next is 104. 100 is here. So 1, 2, 3, 4. Hapo utakasako. And the next is 111. 110. So 111 is here. The next is 104. 104 is here. The next is 122. So 120 is here. So 2 is here. The next is 118. So 8 is here. The next is 126. Here. The next one is 114. 114. So it's here. The next is 117. 6, 7, somewhere here. The last one is 123. So 1, 2, 3. So 3 is here. So you join them using a very smooth line like this. That is skyline number 3. Have you finished drawing?
Yes.
Good. So now we are told to make inferences. Inferences are the conclusion that you can make. So down there, the inference. The inference utaandika hivi. Skyline 1 is within control. Skyline 1 is within control, but caution should be taken. Since it appears headed to being out of control. It appears headed to being out of control. You can see by the time we do 14, 12, 14, the pattern is to be maintained. So caution should be taken. Point number 2, skyline 2 is within control. Skyline 2 is within control. But the inconsistencies should be investigated. Skyline 3 is out of control and corrective action should be taken. Skyline 3 is out of control and corrective action should be taken. Okay, so on your own, you will attempt this question that was tested in September 2015. September 2015 as question number 3C. Question 3C as question number 3C. So that was the second method of the investigations. The third method of investigations is called decision model. Now, decision model is very similar to this one in terms of the probability. It is also based on probability, normal probability distribution, and it also has the same two assumptions I explained earlier. The only difference is that this one considers the costs and benefits. And according to this one, you should only investigate variances. You should only investigate variances if the benefits are at least equal to the cost. The benefits are at least equal to the cost. So we are going to handle a question there. Question number 4. And this question says, from past experience, a company operating a standard cost accounting system has accumulated the following information in relation to variances in its monthly management accounts. Its variances fall into two categories. We have those which are not worth investigating and those which are worth investigating. For the second category, corrective action has eliminated 70% of the variances, but the remainder have continued unchanged. The cost of an investigation averages that 500, that of correcting variances averages 5,500. The average cost of any variance not corrected is $52.50 per month. The company's policy is to assess the present value of such cost at 2% per month for a period of 5 months. You are required to recommend in supporting calculations whether or not the company should follow a policy of investigating variances. So we are looking at this method, statistical decision model, statistical decisions model method. That is the one that we are looking at. And in this, we will do a decision tree. We will do a decision tree. Now, for you to do the decision tree, there is a working that will require the present value of annuity, which we know is the amount 1 plus R raised to power minus n, you divide by R. I think that's the formula that we use, if I'm not wrong. So this will be, the amount is 52.50. 1 minus 1 plus 0.02, which you raised for minus 5, you divide by 0.02. That is what we shall do. And the answer that I'm getting is 24,746. Have you gotten that? Okay, we need to come up with a sketch. We need to come up with a sketch of how this tree will be drawn. And the question is, we can decide to investigate, or first of, yes, we can decide to investigate or not investigate. Investigate or not. Whatever case you do, there are two types of variances, those which are worth not. Worth not. Those which are worth, those are not. Then for those which are worth, you will attempt to correct. And therefore they will be corrected and not corrected. But the ones that are not, you don't attempt to correct. The same case here, now that you do not investigate, there is no correction. And even here, there is no correction. So that tells you we are going to have a tree that has 5 tails. 1, 2, 3, 4, 5. So with that, we come and do the fair copy. The fair copy, or the correct, the final copy. The final copy. Now the final, I keep on telling you that when we are drawing a division tree, we normally go to the end here. That's where you take your tree to. I wanted to bring them out there, but I can work them as independent workings. Now that they are no revenues. Now that they are no revenues. So this is how it will be. 1, I go for 1. 1, 2, 3. 1, 2, 2, 3. So 1, 2, 3, 4, 5. So these ones are corrected. These ones are not corrected. And if they are not corrected, in the words of the examiner, So they have continued. So they have continued. That reflection is disturbing me. So here we have those which are worthy, attempt to correct. Sorry, I think I'll have to change because that reflection is affecting my work. Let me do it this way. 1, 2, 3, 4, 5. Let me put it up at that point. So here I'm saying they are corrected. These ones are not corrected. So this is 1. So I was here now. So this is where I'm saying their worth. Attempt to correct. You attempt to correct. Not worth. No attempt to correct. And if there is no attempt to correct, they continue. They continue. The same case will apply here and here. So this is number 2. This is number 3. Now this one is an option. So if it's an option, it's going to be drawn like this. And this one is also an option. So this is number 4. So what you are saying here, investigation. Here, no investigation. No investigation. When you do whatever you do, you get those which are worth or not worth. Then here, no attempt to correct. No attempt to correct. And therefore they continue. Then the same case here, no attempt to correct. And therefore they continue. So that is how the fair copy looks like. Haya, ukimaliza uniambie.
Done. Finished.
Good. All right. Let's now record the costs. So reading the question again, we are told those which are not worth, they are 64%. And those which are worth, they are 36. So hapa andika 0.36, hapa 0.64, hapa 0.36, and 0.64. Then we are told for the second category, corrective action has eliminated 70%. So those which have been corrected are 0.7, not corrected 0.3. The cost of an investigation averages 3,500. So you inawekwa hapa where we are doing the investigation. 3,500. And that cost of correcting is 5,500. So that is put here, where you have the attempt to correct. The average cost of any variance not corrected is that. So that is the one we computed here. So the ones that are not corrected and they continue, the cost is 24,746. The same case here for those which are worth 24,746. Yeah. So from there now, you compute the costs. So investigation, so the cost of, you're talking of the cost of investigation. You have to do the investigation, that's how it's computed. First of all, you spend this one, 3,500. Then you spend this one, 5,500. But this one is only spent if they are worth. So you factor that probability. Then if they remain uncorrected, it is 24,746. And that one, it is just 3%, 30% that will not be corrected. And you must remember that this 30%, it is of this 36. So that 6 still applies there. And cost of no investigation, it is just one. This one, 0.36 multiplied by 24,746. So compute those two and then you tell me what you will advise, whether we should do an investigation or not. Are you through, Shari?
Yes.
Good. So what do you advise? Should we investigate or we should not?
We are comparing in terms of which has a higher cost.
Yes.
So cost for investigation is higher than the cost of no investigation.
So which one is better?
We don't investigate.
Yeah?
We should not investigate.
Because it has a higher cost, eh?
No, if we investigate, we will have a cost of 78.22. But if we don't, there's no investigation, that is 74.23.
So you go with the one that is lower.
No investigation.
So you should take that there is no investigation, eh?
Yeah.
Okay. Okay, so now I want us to end the lesson with drawing a reconciliation statement. Now that we have computed those variances, we now show how to reconcile. How to draw a reconciliation statement. And I want us to use No, for your assignment, for that other one, utajibu hii swali ya November 2018, question 2A. November 2018, question 2A. November 2018, question 2A. So I'm saying now we want to see how do you reconcile profits reconciliation statement. Profits reconciliation statement. And I'm going to use a question that was tested in November 2017. November 2017, question 3B. November 2017, question 3B. So in this reconciliation, we have details. We have a column where we record details. We have a column where we record the formula. We have a column where we record the workings. And then we have a column where we record the amount or the answer. So looking at this question, we are told that Woodmaster Limited makes quality wooden benches both for indoor and outdoor use. Results have been disappointing in recent years, and a new managing director has been appointed in order to boost the production volumes. After the initial assessment, the director has noted that the budgets had been set at easily achievable levels for employees. He argues that employees would be better motivated by setting budgets that challenge them more in terms of higher expected output other than changing the overall budgeted output. The director has not yet altered the standard cost card. The budgeted output and sales for the month of October was that. The standard cost card and this output is as given there. Overheads are absorbed on the basis of labor hours, and the company uses an absorption costing system. Stocks are valued at standard costs. There were no stocks at the beginning of the month of October. Actual results for the month of October 2017 were as follows. So we are given that. The average monthly production in sales for some years prior to 2017 had been 3,400 units, and budgets had previously been set at this level. Very few operating variances had historically been generated by the standard cost used. The finance director suggested that an absorption costing system is misleading and that marginal costing system should be considered at some stage in the future to guide decision making. So you are told to compute the variances and then you do a statement that reconciles. So the first thing that comes in here is called budget profits. Budget profits. In the formula, we are going to use the initials because we already have these formulas elsewhere. Now, this one is given as budget revenue you minus budget costs. Budget revenue, you minus the budget cost. So these guys have already computed for us the profit per unit. As you can see, it is 280. 280 multiplied by the budget units of, or maybe let me comply with the formula as I've written so that it does not confuse you. According to the budget, we want to sell 4,000 units at a selling price of 2,200. And the cost per unit, or rather 4,000 at a cost of 1920. So if you work it out that way, that will be 4,000 times 280. It is 1,120,000. That is the budget. So operating variances, or just let's call them variances instead of so variances. I've avoided the word operating because now we are reconciling. And you remember for the price I told you it's slightly different. So the first one that you bring is sales price. Sales price. Now for sales price, I told you it's given as budget selling price minus actual selling price. You multiply by actual sales units. Actual sales units. So ukiangalia hapo juu, the budget selling price we know is 2,200. Now ukiteremka huko chini, you can see where we have sales. You can see where we have sales of 7,200,000. 7,200,000. You divide this by the units that were sold, 3,200. That will give you the actual selling price. You multiply this by the actual sales units, 3,200. So if you take 7 million, you divide by that 200. Now 2,200 minus that answer times 3,200. I'm getting 160,000. And this 160,000 is favorable because the actual selling price was higher. It's favorable. The next one is called sales volume. Now for the sales volume, the formula we know is budget sales units minus actual sales units. Budget sales units minus actual sales units. You multiply by standard contribution margin. Standard contribution margin. So the budget sales was 4,000. The actual was 3,200. Contribution margin, we know it is the selling price, 2200. You minus the variable cost. Ukirudi hapo juu, utaona kuna variable cost ya 800. Kuna ingine ya 320. Na kuna ingine ya 160. That is how we get the contribution margin. Selling price minus the variable cost. So this one will be giving us a contribution of 920. If I multiply by 800, I record 736,000. Now this 736,000 is advanced. Is advanced because my actual sales was lower than the budget sales. The next one is material costs, direct material costs, which is given as a standard material cost minus actual material cost. Standard material cost minus actual material cost. So ukienda hapo juu utapata 1 unit was supposed to cost us 800 for material. Now ukiteremka hapa chini, you can be able to see total production was by information 3 hapo katikati. Total production was 3,600. So that will give you the standard material cost. The actual material cost is given down there again in information 3 as 2,800,000. So if you take your calc, it will help you to see that 800 times that 600 minus 2.8. I'm getting 8,000, which is positive, meaning my variance is favorable. This one is smaller than this. Huyo mwingine anaitwa labor cost. Labor cost is standard labor cost minus actual labor cost. Standard labor cost minus actual labor cost. And ukiangalia hapo juu, the standard per unit is 320. That is the standard labor cost per unit. And the units produced, they are 3,600. You minus the what? The actual labor, which is 1,120. 1,120. So this gives you 320 times that is 600 minus 1120,000. So again, that is that 2,000, which is favorable. That 2,000, which is favorable. The next one is variable overheads. Variable overheads. Now the variable overheads, we compute the total. Or you can just bring it here. Is the standard variable overheads minus actual variable overheads. Standard variable overheads minus the actual. So ukikimbia hapo juu unapata 160 multiply by that 600. You minus the actual there, which is 600,000. 600,000. So this one has 160 times that 600 minus 6 exponential 5. With getting 24,000, which is advanced. 24,000, which is advanced. The next one on the right is called fixed overheads. And fixed overheads, there are two of them. The first one is called expenditure. The first one is called expenditure. And the expenditure is given as budget fixed overheads minus actual fixed overheads. Budget fixed overheads minus actual fixed overheads. So the budget should be 640 times the budget units of 4,000, as you can see up there. And the actual is 1,960,000. So that is giving me 600,000. Have I done the right thing? I have said it is 640 times 4,000 minus 1960,000. Yeah, so it's okay, 600,000. And this 600,000 is favorable because I spent less. Then we have what we call volume. Now, volume is computed as budget output units minus actual output units. Budget output units minus actual output units. You multiply by budget fixed overheads per unit. Budget fixed overheads per unit. So this one is a budget of 4,000. The actual was at 600. And the cost per unit was 640. So it is 640 times 400. 256,000. Now this 256,000 is advanced in terms of operations because we got a smaller output. But for purposes of reconciliation, we interpret it vice versa. So this one will be taken to be favorable. Be taken to be favorable. You take it vice versa. And then finally, you come and get the actual profit. The actual profit is given as actual revenue minus actual costs. Actual revenue minus actual costs. So the actual, so this one they have done it, so we don't need to compute, we can see it there. Or maybe I can put it for record purposes. 7,200,000. The cost of sales is 5,712,000. So that the actual profit is 1,488,000. So two things that I wanted to note here. One is you get the budget profit. You add favorable variances. You add favorable variances. You less adverse variances. And that will give you what we call actual profit. So chukua calculator tuangalie kama itakubaliana hivi. So utachukua 1120 add 160 less 736 add 80 add that 2 less 24 add 600 add 256. Sharim, is it reconciled?
It's when I'm doing, but I'd like to ask hapo kwa budget profit ya kwanza.
Yes.
It's 4,000 times 2240 ama hiyo ni 3240.
Hapa? Hii ni 2200. The selling price, the budget selling price. These are the budget units. Na hii ni budget selling price. Na hii ni budget total cost per unit.
Oh, sawa.
Yeah. Which is the same thing as hapo wamekupea 280. If you take 280 multiplied by the 4,000, it will take you back there.
Okay.
So check whether they are reconciling and let me know. Are they reconciling?
Yes.
Good. So that is how it's done. You take the budget profit, you add all the variables, you less the advances, it will go to the actual. The last thing that I want you to note is the fixed overheads volume variance is only included if stocks are present. If stocks are present. If the question does not have opening or closing stocks, you should not use this one. This one should not be introduced. So if you are reconciling a question, they sold everything they produced, you don't compute this one, or you don't bring it here. You can compute, but you don't bring it in the reconciliation. So it only applies kama hiyo swali on closing stock or opening stock or both. So if that is well understood, then I can suggest another question that you can look at. Kuna ile swali tulikuwa tunatumia when we began variances. that question required you reconcile, so you can look at it. And also, this question of December 2014, question 5. You can attempt the December 2014, question 5. So there are several questions that are there for reconciliation. So what I want also to say is that this is always the format. Anytime ukiona swali ya reconciliation, unaipanga hivi, huwa haichange. Unapanga hivi, then you work out to the figures. So that is good. We call it a day in a lesson at that point. I will communicate, but I don't think we will have a class. I don't think we'll have a class. Let me see, I need how many lessons to complete what is remaining. I think Tuesday, Saturday, we shall be able to finish what is remaining. So on Monday, we shall not meet. Monday, we shall not meet. So we meet on Tuesday.